Good morning, everyone. It's an absolute pleasure to welcome you all to the inaugural session of today's event. We'll dive deep into enablers of growth and how NBFCs can remain agile yet resilient in the dynamically evolving landscape. Today's discussion brings together sharp minds and seasoned leaders who have been shaping the sector from the front lines. It's wonderful to see this energy in the room today as we kick off the inaugural session. So I'm really excited about this conversation because this isn't just about lending. It's about mindsets, models, and momentum. So to start with, I'll start with a general question by asking each one of you. When we look at the next 5 years, what do we believe will be the biggest driver of NBFC growth? Is it going to be tech, access to capital, or the regulatory environment? And most importantly, why? I think, Sanjay ji, we can start with you.
Good afternoon. Good morning, everyone. I think while all three are going to play their own role, but I think technology is the one that I would choose because I think access to capital is becoming more and more available. NBFCs are seeing growth. It's not that their growths are being limited by non-access to capital. Also on regulation, I think we can see regulators opening up to many digital interplays. And I think as time goes, that will continue. But technology can play a huge role because India has a huge unaddressed market. And technology in many ways, whether it's voice-based technology, whether it is AI-based technology, whether we're talking of access to better data sets, government is already talking of digitizing the property database. So many such things will enable technology to really start going deep into the unaccessed markets and even better access to the already being accessed market, so to speak. So technology, I think, will play a huge role. Everyone in the NBFC world should be vigilant about how technology can be used, how it can disrupt, and how you can disrupt. I think in the last 4 or 5 years, the NBFCs have been a lot quicker. And when I talk of NBFC, I'm also including fintechs in that. And in fact, they were so agile that banks had to move and start accepting or embracing that use of technology. I think this will continue. And I think therefore it will be the biggest driver.
Sanjay ji, iFinance has been a front runner when it comes to supporting MSMEs, especially in the tier 2 and tier 3 cities. You're known for your high touch service model, which is so important in MSME segment, but also being digitally agile. How do you strike that balance between personalized service and tech scale lending?
Before I start, I just want to take a minute to tell you that iFinance primarily focus on the micro scale MSMEs. So these could be manufacturing units, trading units, service units, which are spread across the country. We are in 21 states and more than 500 branches. And the focus is that how do you give them access by interpreting what their income is and using various alternative data points to figure out what their income is and how to lend to them. We have today in the last 11 years or so lent to more than 10 lakh enterprises. So we have touched a large number of enterprises, so to speak, but it is still a very small scratch on the real problem because there are almost close to 6 crore plus enterprises in that space. Now, the point that Aastha made is a very relevant point for us because one big challenge is that the ticket size is small and we can't afford to have a very expensive setup to service these customers. And yet, we cannot today rely on the customers coming to us digitally onto our website or through various digital platforms because they're not comfortable with that approach. They're not used to that approach. So we have to set up branches and at the same time use a lot of technology to keep the costs down. So it's a good optimization of having people on the field, having 500 branches, and yet keeping the cost down. And I think, therefore, it's a balancing act, as Aastha mentioned, that you have to balance. And as time goes, I believe more and more use of technology will come to fore. Our customers who never used UPI or any other means today, almost 40-50% of them use UPI as a method of payment when they bounce. Even on ACH, 95% of our customers have ACH. So gradually that movement will happen, and I hope that very soon there will be a day when our origination will be digital and we'll be shrinking our branches back to a more reasonable number. But I think that will take time.
So economies of scale is what we can presume is the USP of iFinance. Great. Saibal ji, can we have your thoughts? What is going to propagate the growth of NBFC?
That it may be technology, it may be policy, it may be whatever, but centricity of the people whom we are catering, possibly the main thing we have to look at. The need of them, are we catering them? The need, the way they want to do the things, are we supporting them? When we are talking about the policies, are the policies conducive to cater them? Are we getting enough fund for the NBFC? NBFC also raises fund. Are we getting enough fund to cater them? Technology, is it really people-centric technology, or it is very much your supply-side driven technology? We have to think of this one, but we have to center our view on the need of the people. If we can understand that one, then we can moderate all these things. As you know that Sa-Dhan, we always do all these things, making the things available to the people, conducive to the people, and usable to the people. So my point would be definitely that the people centricity will be the main thing to drive it. If people are not there, if the market is not there, we are also not there. Technology, what will we be doing with technology? But technology is one of the things will include people inside. That's my thought, primary thought, that we have to keep our view on people. We have to make those technologies, policies, everything very people-centric, that they can access it, they can use it. Technology over the period of time, we have seen that at a point of time, we have this apprehension that whether we can use, eventually me also, when this UPI started, I lost some money. So I transferred it, and this your shopkeeper, he told that it didn't come, sir. Then I paid him. I didn't want to fight with him, but I paid him another money. And I thought that I will never use this one ever in my life. Now in my wallet, you will see, very 10, 50, 100 rupees are there, maybe 500 rupees. So everything is on technology. So it has to be coming. There is no other way but technology, but it has to be very people-centric.
Absolutely, absolutely. I think the user friendliness of the technology has a big role to play in adoption. Technology तो बहुत बना सकते हैं, but अगर adoption नहीं है, then it becomes very difficult for it to scale at a rapid momentum. So Dr. Saibal, Sa-Dhan has been instrumental in shaping responsible microfinance in India. As NBFCs increasingly tap into informal credit markets, what do you think are the guardrails they must follow to ensure they're building and not risking systemic trust?
Okay, it's
also, how is Sa-Dhan collaborating with NBFCs to build capacity for responsible lending, especially in the microfinance space?
Okay, there are 2-3 things I need to tell you. That Sa-Dhan, being one of the world's largest association and network of microfinance segment, we have a lot of things to do. And also, there's the associations and the sector of microfinance look at Sa-Dhan, that what are we doing and how this market of microfinance in India is going on. Because every 5 years we have seen challenge, and every 5 years we have seen that we have overcome that one with a stronger self. Now, having said that one, now we are talking about this responsible finance. Sa-Dhan is the first one across globe developed this code of conduct for the sector. We developed it in 2007. The first code of conduct for the sector was written and also promoted in 2007. Then later on it turned into industry code of conduct. Many institutions, they also chipped in. Now it is the industry code of conduct. Now when we are talking about this code of conduct, we have to also understand the sector I represent. I represent the sector of microfinance. So microfinance is not the mainstream banking. Microfinance is a different volume altogether. It is more than a finance. It is more than this behavioral economics than finance. Now there is a pull and push. The poor people who have never got fund from anyone, they want to get more money to manage their risk. And we also, over the period of time, we have seen challenges. We couldn't understand what kind of indebtedness was there. Even today, the major challenge is your data asymmetry on Credit Information Bureau. We do not have exhaustive data of the client. We only get the data of NBFCs and your banks. We do not get the data of your Nidhi companies. We do not get the data of cooperatives. We do not get the cooperative societies I'm talking about. We do not get the data of your whole lot of your not-for-profit. So, and also self-help group. That's a major contributor. We do not have that one. Our segment, the NBFCs who are working in this segment, they are also having a highest risk because we don't get the data. This is one of the major problem of this one. So now what we need to do? There is a pool that people want more money to this risk one, and we also want to do our business. It is our that we have to also make ourselves sustain. So we have to make a balance. So over the period of time, we saw that there is the pull and push. Both of them were going little bit higher. So we have stopped that one from industry level. So we have put guardrails that to one person we can provide up to 3 credit lines to one person, and that too after that too also up to 200,000 your total indebtedness. So there are other also. These are the major things we put. And what we are seeing, once again, it has come down. Our PAR has come down. Everything. If we get the data transparency, if we get the data, actual data, we'll be happy to cater them. We also do not want to lose money. We also do not want to spoil the sector. We also want to do a very good business. We also do want to do a social business. So these are the guardrails we have put on the system, and it is working well. And from the association, over the period of time, we have seen that these things, your this requirement of the people are also changing. They need more money. Like in the third cycle, fourth cycle, we have seen that the person who has taken, for example, 1,000 rupees, now they are asking for threefold. So we have to also assess them. We also have to cater them. Reserve Bank of India, our one of the success of Sa-Dhan is making this your qualifying asset and non-qualifying asset a little bit once again being very people-centric. Now those people who are asking for more money, we can cater them. That's what I was telling you, that we need to keep focus on the people, that what's their need, how they want to do the things, what's their requirement. If we work accordingly, all the business will go on and it will run well.
Thank you. Thank you so much, Saibalji, for your wonderful thoughts. I think coming to Kalpesh, yes. Kalpesh, shifting gears to the investment side. We know wealth creation needs regular, disciplined investing. SIPs, insurance premiums, long-term financial habits, all of them need consistency. But new generation of investors is distracted, impulsive, and not always financially disciplined. What's your take? Do you think NBFCs have a role to encourage long-term investment behaviors in this environment? Any tools or behavioral nudges that are working?
Hi, good morning. First thing I want to say is just like collections in the NBFC scheme of things, SIPs and even insurance premiums, I would say, are the form of similar collections only, which are supposed to be driven by kind of monthly, payouts and all. And there are two factors which actually enables it. One is obviously the behavior pattern of the individual. The second is the technology that you're using to ensure that they are more driven and the operation part of it. So behavior aspects actually I feel are more interesting because I keep on saying this, and I heard both guys out here, and one is obviously the technology part, the second is the human behavior part. But one needs to understand that technology is right here already happening while we speak, and in the next 4 to 5 years, all that can be automated will be automated. So it's a real time thing that is happening and everybody will benefit. It's like autopilot. So just because autopilot came in, the pilots did not vanish. So the technology and AIs will not ensure that we vanish, but we will probably, it is more assisted intelligence is what I call than artificial intelligence. So I feel it's right now real. On the advisory bit, I feel there was a generation where about 8 years ago, till about 8 years ago, I think most of it was product pushing, product selling, and all that. So the type of advisors are changing. They were replaced and are replaced continuously by people like us who are engineering background, understand risk analysis more and probably operations more. So this is right now a generation of risk and operations. The next generation, which is another 4 to 5 years, is where the human behavior will actually stand out. People who understand human behaviors, people who understand behavior aspects will replace the guys who are understanding right now just the risk and the operations part, because this will be taken over by the technology part. But as we know, even in economics, in the field of economics, if you see, especially the last 10 years, people who've got Nobel Prize have actually understood human behaviors. And they have got Nobel Prize because of their behavior aspects more than the economics or any formula aspects. So I firmly feel that this is relevant. That how do we understand human behaviors? Which is why, again, coming back to my point, behavior and the technological part, behavior part is more important. And there are many new insights you can see. One is, so let's say SIPs. SIPs about 10 years ago, the entire year, the amount, the volume of SIP in the entire year used to be less than 21,000 crores. Today we have monthly about 26,600 crores. So it's a huge jump that we've seen over the last 10 years. But if we see the attrition in the SIP is about 15 to 16%. Now, if we have to reduce it down, certain behavior aspect that you need to look into. So we started doing certain things, and we saw like the industry saw some patterns. If you have the SIP date closer to the probably salary date, the SIP attrition reduces to as low as 3% from 15%. So these are some very basic things that even the new age startups, they obviously understand that you're going out for a lunch or a dinner, or you will be obviously going out for a Saturday, Sunday, weekend dinner or something like that. So immediately on a Friday evening or a Monday morning, you have spent so much on a dinner, you would have actually done your SIPs. If you miss an SIP, there is a message that comes to you saying that missing 1 month SIP would actually, extend or probably push your retirement corpus by more than 6 months or 7 months if you have a 20-year tenure. So these are all data backed things, but they are very relevant and very insightful for anybody who reads it, including me. So I find these are the personalization and hyper personalization, communication that is happening by using technology is actually very relevant, which also defines the behavior aspects as well. So that is one area where I think a lot can happen. Agentic AI, almost everybody keeps talking about. So that is where I feel a lot upside can come in. Second interesting part was gamification. I never thought, I actually didn't think that gamification would be that big, but it is quite relevant, quite big, and it was like ET Money used to give you badges for all the things that used to do, and people used to get hooked onto it, and still hooked onto a lot of gamification in cred. Cred uses gamification quite a lot. So that pattern is very relevant in the new age generation. Third, obviously, the new age wants to be associated with a purpose. So you attach a purpose to their goals. So like when you log in to your probably wealth app or something, you are this close to getting your home. So if your home target was, they don't want to do the home planning or house planning or 40 crores for home or 10 crores or 4 crores for home. But if 4 crores was the target, the communication has to change. Like you're this close to owning a home, this close to going for a vacation, and that is real time tracked. So this actually drives them quite a bit. Okay, let me just close one of my goals. I'm so close to it, So gamification is real, and it's actually motivating people to be on track. more than any other, risk analysis or legal things. Or I don't think none of us would want to get into a scenario where we have to school somebody to achieve their goals. So, but these are things which are happening right now and which are pretty interesting, which is what I find a little more interesting than the others.
I think constant nudges in the apps and reminding people that you're very close to your goals is something that will probably encourage investing.
Absolutely, absolutely.
And I'm sorry I missed on the numbers that you said that this is the amount of SIPs that are
26,600 now. In fact, last month is 27,000. Yeah.
So these
Per month.
27,000 crores, where are they getting invested? If you could throw some light, is it mutual funds or is it equity that the younger generation or collaboratively people are investing in?
So SIPs will invest into mutual funds, and within mutual funds, equity predominantly, and within equity also we see a larger share now coming into the mid and the smalls than the large caps. So the share of SIP with the fresh SIPs that are coming in, the larger shares are coming into the mid and the small than compared to the large. So that is again another trend we are seeing. The risk appetite has increased quite a lot. In 2008 when the markets corrected, people were wary of getting into the market for another 2 years. But this time when COVID happened, people were right and ready within 3 months to get into the market. In fact, this year has been very interesting. If we see from 19th Feb, which was the highest point where S&P 500 was there, and I keep saying this that being a 80s child, Independence Day is a movie that I like, and I always believe there is a mothership and all the other ship. The mothership is the S&P 500. So when I look at S&P 500 this year from 19th Feb to about 8th of April, you would see a 21% correction in that. And then from 8th April till now, you will see a 28% upside. So the first time probably we would have read about the V-shaped recovery thousands of times, but you can in real time see that happening with one of the largest stock market in the world and within 5 months. So the risk appetite, it clearly shows, has increased quite a lot. Similar trends you can see in many stocks in India as well. Yours is a very, very good story. so yeah.
So if we see, if we ask for your thoughts in the coming 1 or 2 years, say if you take a horizon of 1 or 2 years from here on, do you see the market falling or do you see an uptrend?
See, nobody knows that actually, no matter what I say.
Just your thoughts.
I feel the market is one step ahead of the GDP. Always, you see 120% of GDP is the market today. So if market is GDP is about 4 trillion, market would be about 5 trillion. That is across the world. So if we are talking about a GDP of let's say 10 trillion, you have my answer there. So we see the markets and the market cap actually rising quite a bit in the next at least 7 to 8 years. This is an India story, and within that also, I feel it's a huge consumption story, especially in the rural side. Rural consumption is already seen, and now urban has also picked up this last 2 months. But I feel 60% of our GDP is is consumption, out of which majority now is picking up from the rural side. So if we look at the overall GDP and the 60% continues, we will see probably 2.5 to 3x of upside just in the consumption story. So that is a very, very good story to probably hold on to create wealth.
Thank you so much, Kalpesh, for your wonderful thoughts. So rural areas bring us back again to the tier 2 and tier 3 cities where the NBFCs have a pivotal role to play. So, Sanjay ji, one major thing that, I, coming from the NBFC background, feel that income assessment has been a challenge. So, if I may ask, how do you battle that out in your organization, the income assessment of your borrowers?
I think income assessment clearly is one big challenge that iFinance has tried to solve for. And the problem is that when you look at these small shopkeepers or small manufacturing units that I talked about, they don't maintain books of accounts, so they don't have audited balance sheet or P&L. They do have bank accounts, but most of their business transaction happens in cash, so there's no transaction that you can see in the bank statement. And most of them are also below the GST threshold, so you don't see any GST return or any meaningful return. In that scenario, what we have done is that we have followed a cluster-based approach where we say that a type of business, let's say someone manufacturing shoes in Agra, is a type of business, and if we study that business, we start seeing patterns which are observable and which can correlate with income. For example, number of people working there, if there are 5 people working there, they'll produce 200 pairs of shoes per person. If they have 2 pasting machines, that's the volume that you will see. We know that sort of margin that will be there on every shoe. So in some ways, you can make a leap and say that from 5 employees working, this is the sort of sales turnover that you will see or the margin that you will see. And you can correlate with other areas, other things like the total area of that shop floor that that unit uses, the electricity consumption, etc. Because ultimately the business person is smart enough to know that he cannot afford to pay rent for a very large space. So given his sales, he will have appropriate amount of real estate, so to speak, to look at it. And similarly, you see these patterns in every type of business, whether it is shoe manufacturing or it's a tailoring shop or it's a dairy or whatever. And these are the parameters that we have computerized into a system so that when a loan officer goes and he finds that there is a shoe manufacturer, the system prompts him for the relevant data points and questions, which are then used to compute the income, etc. So it's an alternate use of data, as I said, and it has been used by us for the last 11 years, and it has only got better. As we have got better at this, and we have had similar data points, for example, in grocery stores, we must have given loans to more than 100,000 grocery stores. So based on that, we have derived a machine learning model, which now looks at various data points and just projects income or a margin. That's been working for the last 4 or 5 years and has been working well. So the idea is to look at alternate data, use that as much as we can, and as we get more data points of that particular cluster, we can look at moving them into a machine learning sort of model, which can be refined as we go along. So I think that's the answer that we have. I'm sure that there can be multiple ways of solving this same problem, but that's our solution to this problem.
Great. Thank you. Thank you for the wonderful insight. Coming to Saibal ji, please, can you throw some light that what is the regulator doing to smoothen out the income assessment process? Like we see a lot of credit bureaus participating in providing the income data of the borrowers, and how is Sa-Dhan taking this forward?
Unlike mainstream middle class, the sector we cater, there's a big time problem because we do have bank account, but only once it comes the money during when we provide them money or some these government schemes money are coming. So this is only thing. We do have, they may have your land, they may not have their land. If they are daily wage worker, they may get job, they may not get job. So it is mostly your self-disclosed one. But what we do, the unique thing of microfinance sector is working with the people, the trust of the people. So when we talk to them, they generally give us the right data, right kind of information. Now, this is one part of the thing when we are getting the data. Second part, what Sa-Dhan is doing, Sa-Dhan has already developed a format and also some technology where your income can be assessed. If you put the number, it will give you a kind of understanding that what kind of income that person has. We are also talking to these people, once again technology is coming. We are also talking to a couple of these technology company and international agencies that how to identify, it is not really income assessment, how to identify the right client and what could be their income. So our is right client plus income generation. We are seeing that some sort of this proof of concept is coming up, and gradually possibly we will once again, if we see that it is really workable, then the way we do, we will spread it across to our member that using AI, how can we develop this your income and also right client to cater. Now if you talk about the regulator has already given us leeway that it is at our prerogative to identify, but it has also given us a threshold of 300,000 this your family income. So they are always, one of the things I have worked like around 11 regulators across globe. one of the most intelligent regulator is Reserve Bank of India. From my experience, I can tell you they may not be knowing the subject. In 6 months of time, if you work with them, they will be mastermind. So they are always like, if you give them as a policy advocacy person, if you work with them, if you give them the data, if you make them realize, if you take them to the ground and really make them like, what do you call it, like in their system, they will definitely help you. Yeah. If we are doing wrong, they will watch it for good some time and they will then pull us up. They have done it already. As you know, two of our institutions, they were not doing the right thing. They have pulled it up. It's a good thing. And we are also knowing that, okay, we cannot go beyond that. But what I can tell, if you are a regulator, I mean, an Indian regulator, this Reserve Bank of India is extremely good. And we as an association and SRO, we work with them, we give them the data, we also bring the challenges to them, they understand that one, and that's why they have given us this leeway, and they are continuously giving us the leeway to make our product, make our assessment more people centric, more proper. So this is the take of your regulator, and from us we are always on field, always on capacity building side of our members.
So you think the regulator is laying down strict guidelines to control the lending, and whatever lending is happening from the NBFC, it has to be responsible. So the regulator is actually working on that.
Yep, they are working on that. And in the last year, this event of Ministry of Finance, DFS, Ms. Sitaraman has actually whacked this banking fraternity, not giving the money to your NBFCs. They're telling that your this PSL every year it is increasing, and you are giving it to NABARD and SEED. Why are you giving it? Why don't you give it to NBFC segment? Give it to them. This is a very, very positive message for us that we should be getting more money in our system.
Absolutely. Absolutely. So connecting income with investing, coming to Kalpesh. So this is directly proportional. Income is directly proportional to investing.
Yes. Yeah.
So how do you think the surge in income is impacting the investing part, and how are you trying to tap the new investors?
See, risk, as I said, understanding risk was one of the major things in the last 10 years that people have done in the wealth management industry, especially. And I think even the clients are more informed now. So when I started my career, I think 2003 or something, we never had that much of funds, and also what I did was I took some loan from the bank and then started investing in the lines of futures and options, and did quite a bit. So 10 lakh loan was there, which grew within 3 years to about 2 crores, because I was managing Fort, so there were a lot of people who I knew, and we were doing. And then 2008 happened, I lost 2 crores and I lost my second home also to cover the margins. So and then we restarted again. So I think behavior patterns mostly are individual oriented. You want to make it big, so you take much more risk. When you already make it big, you never take much more risk. But there are trends that are changing. So one thing I can say is we have, I think, one of the largest 90 plus year segment that any wealth firm has in India. I have more than 5,500 customers who are 90 years and above, and maybe with us for the last 2 to 3 generations. But their risk appetite has suddenly changed quite a lot. So what
In terms of, is it increasing, or
it is increasing. It is increasing. In fact, I have a good 93-year-old client, very very nice client who whenever I meet him, he says that show me the most riskiest product you have, because he's settled. His sons are settled. His grandson is settled now, and he's got some money which he's kind of aggressively investing into ideas that he feels could give better returns. And believe me, his portfolio is doing far better than the other 2 portfolios in the family. So it all depends upon the kind of risk appetite you're taking, your own understanding also over the period of years by investing that you've gained. And but there are trends that are changing. So there was a recent report by 361 also, which also clearly mentioned the same thing, that 60 plus segment 8 years, 10 years ago wasn't participating into equities as much as they are participating today. So people are not very happy, I think, with the fixed income kind of returns. Now, with rate cuts happening again, the returns will reduce down on the fixed income side. So they want some exposure on the lines of equities, and that's something again, participating in the India story. So there are many trends that are changing. There are trends on the lines of the youngsters as well. Trends on the lines of the 60 plus. Well, one that excites me the most is the 60 plus segment. Also, second is pension. One thing probably is getting unnoticed is the pension funds. We won't, like HDFC pension fund, for example, has today 1,30,000 crores of AUM, and it has grown by more than, I think, 200, 300% over the last 3 years. Yeah. So pension, now that the population is pretty young, I think 15 years, 20 years, 25 years down the line will be one of the oldest population in the world. So I think pension plans will become very, very, very important. Retirement is a very, very big story. So we are completely glued on to the retirement part. We are having a tagline also now: think retirement, think Bajaj Capital. So we are completely focused on the story that probably will build up over the next 10 years.
Wonderful. Wonderful. Thank you so much, Kalpesh, for your wonderful insights. I think in the interest of time, we can quickly sum it up. I'd like to thank all the speakers for their wonderful practical insights. I hope this discussion has been very insightful for all the audience present here. Thank you, everyone, for your time.